Are you a sole trader who's thinking about going limited this year? Or perhaps you are just thinking about starting your own business and you're wondering what the best structure is for you to do that in. Well, this video is going to explore that, the pros and cons of each situation, and make sure that you have enough information to make an informed decision. So, why does it matter? Well, choosing the right legal structure can impact not only the tax that you will pay, but the administrative burden of what you are taking on and the complexity. Also, it can affect how clients perceive you. So, some businesses, for example, will only work with other limited companies. So you need to think this through before you get started, or certainly before you make that switch. So, well, what's the difference in the first place? Very, very simply put, if you operate as a sole trader, you are the business is you. So it's very simple to set up and you have full control. The challenge with that potentially is that you are also personally responsible. So you have personal liability should anything go wrong in the business. Limited company, on the flip side, is more complex to set up, it's more complex to run, there's a higher burden of administrative duties, and there will be greater fees actually from your professional suppliers and providers as well. The pro side of that is that there is some more flexibility in terms of tax planning and how you structure your remuneration, and there are some small benefits, but really a lot of those have been taken away from the financial point of view. But most importantly for many people is that you've got limited liability, provided that you fulfill all your responsibilities as the director of that company. Okay, so let's look at the tax implications first and foremost. So I've already said that as a sole trader, you are the business. The business's money essentially is your money. So that means that you're taxed on all of the profits in the business, whether you actually draw them out of the business bank account or not. So you'll be taxed on all of those, and you will pay income tax, and you'll pay class 4 and class 2 national insurance contributions. So income tax will be charged at the normal rate. You'll still have your personal allowance of £12,570 per annum across whatever you do, whether that is sole trade, employment income, other income sources. So you've got your personal allowance, and then above that you'll be charged income tax at 20% up until the higher rate band kicks in at £50,270. Class 2 national insurance contributions, actually if your profits are greater than £6,725 per annum, then the class 2 national insurance contributions actually get treated as if you've paid them, if that makes sense. So you don't actually have to hand over any money, you don't have to report it on your tax return. It will just be treated as if you've already paid those. Why is that important? Well, class 2 national insurance contributions are your credit towards your state pension, and you must have a certain number of years of full payment in order to get your full state pension whenever you come to retire. So it's really important to make sure that you do plug any gaps, or at least know what you need to do to have the full number of years available. If your profits are lower than £6,725 per annum, and you don't have other income sources where those class 2 national insurance contributions are being paid, then you can make voluntary payments equivalent to £3.45 per week at present. Class 4 national insurance contributions then. So class 4 national insurance contributions used to be 12%. They've been reduced over a number of years, and they are currently 6%. So that's on profits greater than that personal allowance of £12,570, right up to the higher rate of £50,270. And then once you hit that higher rate of income tax, where your income tax goes up to 40%, the class 4 national insurance contributions charge drops to 2% on profits over that higher rate band. So quite a lot to think about, but very simple to work out and to know what sort of tax you're going to have to pay. The one thing that often catches sole traders out if they're in the early stages of their business, or if their business is growing at a rate, are payments on account. I'm not going to go into those in detail here, we've got other videos on that, but suffice to say that if your tax liability is greater than £1,000 for the year, HMRC will want you to pay for the next year in advance. So you would have, say it's your first year, you'd have £1,000 to pay, and then they'd add on half of that right now, so you have a £1,500 tax bill rather than a £1,000 tax bill, and they'd want another £500 in July. But as I say, I've got more details than that somewhere else, so skip by this bit. Okay, limited companies then. What are the tax implications in a limited company? Well, limited companies pay corporation tax on all of their profits. So there is no personal allowance like you have as an individual or a sole trader. So all of your profits will be taxed. Currently, the main rate of corporation tax is 25%. However, there are lower sort of marginal reliefs, they say. That means that if your company profits are less than £50,000, you will only pay 19% corporation tax, which is the old rate, on those profits. And then there's a sort of marginal band where your profits are between £50,000 and £250,000, where you get marginal relief. But essentially that means that that element of profit is taxed at 26.5%. And then once you get to over £250,000 worth of profit, everything is taxed at 25%. So you can reduce your profit by making pension contributions or by taking a higher salary. If you take a salary, it'll just be pay as you earn tax. But a lot of people choose to remunerate themselves by dividends whenever they have a limited company. Dividends can only be paid after corporation tax has been deducted. And the corporation tax falls due 9 months and 1 day after the year end for your company. Okay, so I suppose I should mention actually dividend tax rates. So for 2025-26, there is a £500 dividend allowance, which is taxed at 0%. So no tax to pay on that dividend allowance. Thereafter, within that basic rate band, you would pay income tax on the dividends at 8.75%. So that's on income. Again, you get your personal allowance whenever it's you drawing the dividends out, and you'd pay that 8.75% on dividends from 12,570 up to that higher rate band of £50,270. The higher rate tax band then for dividends is 33.75%, and the additional rate band is 39.35% currently. You know, financially, we used to say that if you were making profits of between £30,000 and £40,000, it probably made sense for you to become a limited company. That number is being ever reduced, and as I intimated at the start, your fees, your accountancy fees for a set of accounts to HMRC for a limited company are much more complex than for a sole trade set of accounts and tax return, that your accountancy fees will be higher as well. So you need to factor all of these things in whenever you're making your decision. Everybody's circumstance is different, and you may also wish to consider if you've got other family members who might be part of the business, and you can remunerate them effectively through the business as well. Then sometimes that makes it more sensible to go down a limited company route, regardless of the profit levels. But everybody's different. So what else do you need to consider? Again, liability. So limited companies offer protection of personal assets. Again, as I mentioned at the start, the professional image, you can be perceived to be a more substantial business, a more professional business, a more experienced business if you run your business as a limited company rather than a sole trade. You can make employer pension contributions. I think I've just mentioned that as well through your limited company, and those are liable to corporation tax relief. So if you've got excess funds in the company, excess profit that you don't need to draw out, you could be building your pension pot. It's the best and easiest way to keep your corporation tax liability low, and also to separate personal wealth from business wealth, because any other way of drawing income out of the business, you're going to have a tax consequence of that. Administrative duties as well. You know, we've talked about that already, and have a look at my video on fiduciary duties of a company director. They are complex, and you need to very much understand the responsibilities that you're taking on whenever you set up a limited company, because you can't just say that you didn't understand or you didn't know. You've got to make sure that you know the rules and regulations, and that and your responsibilities as a director. There are more reporting requirements for a limited company. However, as a sole trader, HMRC are introducing something called MTD for income tax, or making tax digital for income tax, which means that from April 2026, sole traders who have a combined income from property or sole trade business greater than £50,000 per annum are going to have to start to file quarterly reports to HMRC of their turnover and their expenses, and have that all wrapped up then into their tax return at the end of the year. So it is becoming more complex. That number has also been reduced. It's 50,000 combined from 1st of April 2026. From April 2027 it reduces to £30,000 combined, and from April 2028 it reduces to income over £20,000 from business and property combined. So the reporting requirements are becoming more complex for sole traders, certainly professional, successful sole trade businesses. Okay, so to sum all of that up, I suppose when should you consider incorporating? Well, you need to have profits probably consistently over 30 or 40,000 absolute minimum to make it financially worth your while. I might say even higher than that, to be perfectly honest. But it's not all about the financial or the tax implications. So you might wish to have limited liability. You might operate in a business that is potentially a little bit more risky, or have suppliers and customers who are potentially a little bit more risky. You might want some tax planning flexibility, or it might be that you've got other income from employment, for example, or other sole trade businesses, and actually you want to ring fence the income from whatever you're doing into a limited company and keep it separate, so you've only got the corporation tax to pay and you don't need to worry about the income or dividend tax and that. You might have other family members that you want to get involved in the business, and at that point it definitely becomes sensible to look at your options from a limited company. Whether you should say sole trade or not, well, if you're in the early years and you don't think that you're going to make more than £30,000 of profit, not sales of profit, then I think really you should consider just staying as a sole trader, because it's so much more simple. Certainly if you think you might make losses in the first year of trading, any losses from self-employment can potentially be carried back against tax that you've already paid from your employed work, whereas if you're in a limited company just starting off and you make some losses, those can only be carried forward against future profit, if that makes sense. Sole trader, definitely more simple currently. But as I say, we talked about MTD, this might change a little bit. The other thing to consider, if you've got a very simple business, and perhaps you are a couple or a partnership, but if you think you've got a very, very simple business that ticks the other criteria, but your profits are higher, you could consider setting up a partnership rather than a sole trade, and then the profits will be split between the partners. So that's something else to consider. We don't see as much of it anymore, but definitely with the tax changes and the increased burden on a limited company, we are certainly seeing more people considering either staying sole trader and keeping things simple, or perhaps looking at a partnership rather than incorporating their businesses. So to recap all of that, it depends on your situation. We're really, really happy to have a chat, to have a call with you and talk through your situation, if that's something that you think you'd find useful. But definitely do give it some thought before you go ahead, and any questions, drop them in the comments. We're more than happy to answer your questions on here as well. Thanks very much. Bye for now.